everybody's touched a little bit on the second question, which is which deals can get financed in today's market. Are there particular deals which the banks would prefer to see over, say, another deal? Vijay, do you want to start and we'll come back from that end?
No, I touched on that earlier, and it's all down to the counterparty and what are the contracts behind it. Most of the points that Marcus put up in his slide with the money bag typically come into play in any project. There were times when people used to finance 80% for a spot market vessel, but those days are gone. You'd probably look for a contract. You'd probably finance only 60% as a bank. Coming from our perspective, where we actually own the asset and lease the vessels out, it becomes a cash flow play for us. How much of a bareboat rate is sustainable on a long-term basis, because we look for 7 years minimum tenor. And therefore, it's an analysis based on the cash flow of the asset and the counterparty. We happen to be in the shipping business, but typically we think that the model is more aircraft leasing model.
I'd agree with Vijay. I mean, I think deals are getting done. We're certainly doing transactions. But it's the same point I made in the previous discussion, the fact that, a well-structured transaction is very bankable to good clients that you know well and who know their counterparties. So deals are getting done. The criteria for those transactions has never changed. Admittedly, yes, there has been probably less of a level of debt has probably dropped somewhat. But at the same time, from our point of view, of course, the vessel values have dropped. So essentially, we're financing a lot less of the same vessel than would have been 2 or 3 years ago. So it's certainly very attractive from our point of view.
T-Back.
Okay, I talked about other banks on my first response. So that's, in terms of the timing, we'll talk about 2 years. But as the gentleman said, we are doing deals. RBS is doing deals. But we're just doing deals with our existing clients. So on that sheet, having a relationship with a bank that is actually in the market is the hardest hurdle that you have to face. If you do not have a relationship with a bank that is well capitalized, in the market, in your particular sector, then you are going to face that challenge. And therefore, from an owner's perspective, being multi-banked spreads that risk in terms of the longer-term issue. So just going back to the question in terms of what deals can be financed, yeah, the chart said it all, and Nigel pointed out earlier on that in the past, last 3 years at least, all the triggers in which makes a good deal go through our credit committee was being laxed due to the fact that there's much greater competition. However, there is less competition out there, and therefore expect deals to have tighter covenants and be more structured. Despite the fact we're in the low point of the market, you should get, there is less risk for the bank. The downside is less than it was a year, 2 years ago. So 2 years ago. So I think expect more covenants, tighter covenants, and also expect that you are going to get challenged in terms of more detail about your business. So more MI, expectations of what you've done in the past, it becomes much tougher. So just be prepared for more information and more due diligence.
Oliver, would you like to comment on what NBAD would look for?
Well, what are we doing in shipping finance in general in banking? We're dealing with an industry which is largely sub-investment grade. And by structuring debt transaction solidly with a decent proportion of equity, with risk mitigation, we can convert it into an investment grade debt product. That is bankable. The definition of that today looks obviously much different than what it was 2 years ago. Many of the banks that are active in the field of shipping have certain requirements. We have, for example, a very strong local content requirement that is due to the peculiarities in our home market, which is pretty much Abu Dhabi and in the next stage then the UAE and GCC. With the financial crisis, when it hit, most or many of the international banks reduced their lending activity quite dramatically locally. That means all of that urban development in Abu Dhabi, which is still going ahead strongly, needs substantial amounts of capital, largely lending, Where does it come from when many of the international banks have reduced their lending activities locally? It comes from the local banks. So therefore, we have to focus on local projects. So we need a strong local content. That's one of the key requirements to overcome.
If we move on to our last two questions, and maybe we can take those together. The first is the Middle East shipping industry relatively better placed than shipping worldwide? And the second, of course, relates to Islamic finance, and no Marine Money Conference would be complete without the question as to whether Islamic finance can make a meaningful contribution to the shipping industry at present. Marcus, do you want to kick us off on either of those two?
I think for the regional industry, with the oil services concentration, there is a strength there. Certainly what we've seen in recent months and years has been a more favourable, although difficult, environment for any company involved in the oil services sector. And that obviously is a local feature, and there are a number of oil services companies that have prospered through the last 2 years or so. In terms of, and as a general comment to that, I think is about all I have to say on the Middle East industry. But in terms of the